The short call Condor is an options trading strategy. It involves selling or shorting and buying call options. These call options have 4 different strike prices but the same expiration date. This strategy works best when the market is expected to stay within a certain range. Think of a condor with its wings spread wide. The strategy aims to profit when the price of the underlying asset, like a stock, stays within the wings of the condor. This means the price stays between the strike prices of the options you've chosen. The short call Condor is a neutral strategy. This means it profits most when the price of the underlying asset doesn't move much. It's like hoping the Condor glides smoothly without sudden dives or ascents. This strategy is best for experienced options traders. It involves multiple options contracts and requires a good understanding of options trading principles. The short call Condor strategy thrives in specific market conditions. It's most effective when there's high volatility, but the market's direction is neutral. High volatility means that the price of the underlying asset is expected to fluctuate significantly. Think of a choppy sea with waves going up and down rapidly. This volatility increases the potential profit for the short call Condor, as the option premiums are higher. However, the short call Condor also needs a neutral market direction to work best. This means that while the price may fluctuate, it's not expected to make a significant move in either direction. It's like the tide coming in and out, but not flooding the beach or receding too far. In a neutral market, the short call Condor can capitalize on the high option premiums without being exposed to significant losses from large price movements. One of the key features of the short call Condor strategy is its defined risk and reward profile. Both the maximum potential profit and the maximum potential loss are limited. The maximum profit is achieved if the price of the underlying asset stays within the strike prices of the short call options at expiration. This is like the Condor landing safely within its designated area. Conversely, the maximum loss occurs if the price of the underlying asset moves significantly beyond the strike prices of the long call options. This is like the Condor flying too far out of its territory. This limited risk and reward profile makes the short call Condor appealing to some traders, as they know the maximum amount they can gain or lose. Let's imagine you're interested in trading options on Apple, a company listed on the S&P 500. Apple is one of the most valuable and widely traded companies in the world, making it a popular choice for options traders. The current price of Apple is $150. This price point is crucial for setting up your options strategy. You believe that Apple's price will remain relatively stable, fluctuating within a certain range over the next month. But Apple will pronounce their quarterly figures which are not quite clear. You expect volatility. This belief is the foundation of your short call Condor strategy. To implement a short call Condor strategy, you would sell one call option with a strike price of $155, which is slightly above the current price. Sell another call option with a strike price of $160, creating a spread. Buy one call option with a strike price of $165 to limit your potential losses, and buy another call option with a strike price of $170, all with the same expiration date 1 month out. This completes your Condor setup. If Apple's price stays between $155 and $160 at expiration, you will benefit the most. You keep the net premium received from selling the options. This premium represents your maximum profit. If the price moves outside this range but stays below $170, your profit will be reduced, but you will still make some money. Your profit will be reduced. The further the price moves from your target range, the less profit you will make. If the price moves above $170 or below $155, you will incur a loss. You will incur a loss, but it will be limited to the difference between the strike prices minus the premium received. This makes the short call Condor a strategy with defined risk and reward. Setting up your Condor, a step-by-step guide. To set up a short call Condor, follow these steps carefully. First, choose your underlying asset. This is the stock or index that you will base your trade on. Select a stock or index that you believe will trade within a certain range over the life of the options, but there will be an announcement or news. Next, select your strike prices. These are the prices at which you will buy and sell the options. Choose 4 strike prices that are equidistant from each other. This symmetry is crucial for the strategy. The 2 middle strike prices should be around the current market price of the underlying asset to maximize potential profit. Then determine the expiration date. This is the date when the options will expire. Choose an expiration date that aligns with your market outlook. Finally, place your order on your trading platform. Sell 1 call option at the lower strike price to start the setup. This is an ITM option. Sell another call option at a higher strike price to complete the first part of the Condor. This option should be OTM. Buy 1 call option at a lower middle strike price to start the second part. This option also should be an ITM option. And buy another call option at a higher middle strike price to complete the setup. This option should be OTM. Remember to double-check all the details of your order before submitting it to avoid any mistakes. It's crucial to understand the potential risks and rewards associated with the short call Condor strategy before entering the trade. Make sure you are comfortable with the potential outcomes. Exiting the Condor strategies for different scenarios. Exiting a short call Condor trade can be done in several ways, depending on the market conditions and your profit target. Understanding these strategies is crucial for effective trading. First, you can close your position by buying back the short call options and selling the long call options. This method is straightforward and allows you to lock in your profits or limit your losses. This is the most common way to exit a Condor, and it provides a clear and immediate resolution to your trade. Another method is letting the options expire worthless. This can be a viable strategy if you are confident that the market will remain stable. If the price of the underlying asset stays within the strike prices of the short call options at expiration, the options will expire worthless, and you get to keep the premium. This can be a low-effort way to maximize your returns. Lastly, if the market moves against you, you can roll the Condor by closing your current position and opening a new one with different strike prices or expiration dates. This strategy can help you adapt to changing market conditions. Or you sell or buy the options which are in the profit and wait until the stock or index comes down or goes up again. In this way you profit from 2 directions, but it is more risky. It's important to have an exit strategy in place before entering any trade, including a short call Condor. Planning ahead can make a significant difference in your trading success. This will help you minimize your losses and protect your profits, ensuring that you stay on track with your financial goals. Managing your Condor adjustments and considerations. Managing a short call Condor trade involves monitoring the market and making adjustments as needed. Here are some factors to consider. First, market volatility. Changes in market volatility can impact the value of your Condor. You may need to adjust your position if volatility increases significantly. Second, time decay. The value of options erodes over time, known as time decay. Keep an eye on the time remaining until expiration and adjust your position accordingly. Lastly, early assignment. There's a risk of early assignment if you've sold call options. Be prepared to handle early assignment if the buyer of your call options decides to exercise them. Regularly review your Condor position and make adjustments as needed to manage your risk and maximize your profit potential. Advantages and disadvantages of the short call Condor. Like any trading strategy, the short call Condor has its advantages and disadvantages. Let's start with the advantages. First, defined risk and reward. Both the maximum potential profit and loss are limited. Second, high probability of profit. If the market remains range-bound, the probability of profit can be high. Third, neutral market outlook. It's suitable for traders who expect the market to remain relatively stable, but just the announcement or presentation of the figures will create volatility. Now, for the disadvantages. First, limited profit potential. The maximum profit is capped at the net premium received. Second, complex strategy. It involves multiple options contracts and requires a good understanding of options trading. Lastly, early assignment risk. Selling call options comes with the risk of early assignment. Carefully weigh the pros and cons before implementing a short call Condor strategy in your trading plan. Conclusion. Is the short call Condor right for you? The short call Condor can be an effective options trading strategy for experienced traders looking to profit from a neutral market with high volatility. However, it's crucial to understand the complexities of this strategy and the potential risks involved. Before trading a short call Condor, make sure you have a solid understanding of options trading, risk management, and your own investment goals and risk tolerance. Remember to start small, practice with paper trading, and seek guidance from a financial advisor if needed. Trading options involves risk, and it's not suitable for all investors. Ensure you fully understand the risks involved before making any investment decisions. Good luck with your trading, and do not forget to like and subscribe. See you next time.